Let's bring in Paul Nolte, the Senior Vice President, Portfolio Manager at Kingsview Asset Management, to the Future Show here on the TD Ameritrade Network. Good morning to you, Paul. It's good to have you back with us. Paul, yesterday the EIA reported less of a build than analysts had expected, and while we've seen some nice intraday swings, for the most part the WTI seems to have found some comfort right around this $53 to the $54 area. What are your thoughts on that range that we've been in?
Yeah, it's interesting too because it's coming off the rally from the December lows along with the equity markets, but it's got a long way to go just to get back to the halfway point. We remember we topped out at around 75, got down to 45, and we've only made it back to 55, 53. So I think we've got a long way to go yet, but what's interesting to me is we're now pumping and exporting a ton of oil. We're seeing a little bit of a cutback from OPEC. Venezuela is still a mess, but not really a big a player here, or at least on the margins. And we are running inventories actually almost across the board higher than we were this time a year ago. So again, you've got the cross currents of inventory levels and maybe some supply cuts from OPEC kind of messing around with the markets here. And I think that's part of the reason why we're range bound over the last couple of weeks.
So, Paul, we've been keeping an eye on the phase that crude has been in, where it's been closely tracking stocks and stock index futures products. We saw them both on the decline in October, November, and into the December lows. They've rallied back, though, throughout the month of January. Why do you think we're seeing these products share this close relationship, and do you expect this to continue?
Yeah, I think a lot of it has to do with some of the economic figures and some of the guessing on global growth, and that's part of the reason why I think at least today we're seeing some of a sell-off, certainly in the equity markets, are concerned about global growth and what that means for demand for energy and energy products. The fear was going into December that recession was right around the corner, which means that energy products would probably not be used as much, so demand would be falling off. When the Fed backed off, everybody felt, okay, good, we're in great shape. The economy's should do okay with the Fed stepping away, and energy will recover. But again, as we noted, energy prices haven't recovered nearly as much as the equity prices have on a percentage basis from their highs back in October. So energy should have a long way to go. Obviously, a lot more geopolitical ramifications around energy than there are around the equity markets.
Now, Paul, earlier in the show, we took a look at how India's central bank, they went ahead and took a rate cut from 6.5% to 6.25%. Now, the Fed is easing up on the gas pedal some. Oil prices are at risk as central bankers. I'm wondering if oil prices, I should say, are at risk as central bankers become more dovish.
I think they are, because, again, you got to ask yourself the question of why are they being dovish?
Yeah.
Is it something in the economic data, or is it, again, is it the global markets? And right now, I think you're looking at a global economy that's slowing down. Europe numbers were terrible overnight. Mm-hmm. China continues to slow. Japan slow. Our data is okay. We're probably the best house in the neighborhood, but the neighborhood doesn't really look all that fabulous. So again, that will, I think, put some pressure on commodities in general and energy specifically.
So, Paul, how much have you been hearing about what's been dubbed as the non-OPEC or no-OPEC deal? The U.S. is trying to avoid countries colluding to manipulate oil prices, with the focus primarily on the OPEC Plus deal that could bring Russia into a closer alliance with the UAE and other OPEC member nations. I heard the House Judiciary Committee is set to vote on it today. Apparently, it's seeing some bipartisan support.
Yeah, it's true. And what's interesting is the dynamic has really changed, and I think that's what a lot of people are missing in the energy market right now. We are just a hair's breadth away from actually being a net exporter of crude. We have been a net exporter of LNG now for a little while. So actually, we're one of the bigger players in the global energy market and more of a price setter than OPEC is. So I think, and really many of those other countries, Russia, OPEC, et cetera, Venezuela certainly, are very dependent on energy. But right now, we're really more setting the price than a lot of those countries are. So while it is a concern, I don't put it as a very high concern at this point.
Paul, should we be concerned that Russia and the UAE appear to be forming a closer bond? I mean, I wonder how the smaller OPEC nations would feel about this. I'd imagine that they'd even have less say amongst those two powerhouses.
Yeah, I mean, within OPEC, you're right. That dynamic, I think, is going to play a bigger role. Certainly, the UAE has been a price setter, and then you've had the smaller countries cheating around the sides to get additional dollars for themselves. And I think that dynamic may continue. Russia's hurting. You know, their economy in general is struggling, so there's some incentive for them to get energy prices up as well. But again, you know, they need to get revenue in their door, and the best way to do it is to sell crude.
Yeah, I'm hearing about this deal, and then I'm thinking, well, for the most part, we've heard about OPEC that's willing to cut, but we know Russia, for the most part, has been reluctant to cut as of recent. So, again, that could be a little bit of an area of confrontation for them and possibly hold back them moving forward with this deal. Paul, one more question. We'll let you get out of here. I'm curious what you're seeing in terms of the natural gas decline. I mean, it has been coming off. Obviously, we're getting more production as the WTI production has been up as well. But what are you seeing here? I mean, we're nearing some key levels of support right now.
Yeah, and I think and as you mentioned, the production levels are way up. We're up well above where we were a year ago. We worked off a lot of the very low inventory levels that we had going into the fall, and we're getting out of the colder parts of the year.
Yeah.
So we're seeing builds now that are a little bit more in line with normal levels to slightly ahead of average levels for LNG. So I think we've got some additional downward pressure to go on LNG in the weeks ahead. So we will, in most likelihood, break some of those support levels.
Yeah, we'll keep an eye on it. It actually looks like it's back into levels that we haven't seen since March of last year. So don't forget, we have inventories today. It shows on the full screen there that last week we had a draw of 173 billion cubic feet. Now, I actually noticed today they're looking for a draw of 245, so we'll keep a close eye on that. Paul, really appreciate you joining us and giving us part of your morning here. Traders, that's Paul Nolte, the Senior Vice President and Portfolio Manager at Kingsview Asset Management.